If I asked you, would you rather take $1 million today or a penny that doubles for 30 days, which would you take? Well, let's do the math. A penny would be 1 cent on day 1. On day 2, it doubled and it is now 2 cents. Day 3, it becomes 4 cents since 2 cents doubled. Fast forward to day 10, your penny is now $5.12. You must be happy that you took the $1 million, right? Wrong. Fast forward to day 30, the penny is now worth $5.368 million, and that, my friends, is the power of compounding interest. Interest that you earn on top of your interest is compound interest. If you're currently not taking advantage of compound interest, I present to you the best compound interest investments to consider. But since we know that there's no magical penny that doubles every day, let's look at a real world example. If you invest $1,000 and earn 7% interest, you would have earned $70 in your first year, since 1,000 multiplied by 7% is $70. Now your balance is $1,070. In the year 2, you would have earned 7% again on that $1,000 and the additional $70. Now you just earned $74.90. As we have seen the penny example, the compounding doesn't seem like much of an increase in the beginning, but if you leave the money long term, say 30 years, it dramatically affects your balances. With that said, there are 3 key factors to consider with compound interest. The higher the interest rate is better, since you will earn more. Compound frequency is the rate of how frequent it will earn interest. So a monthly compounding interest will be better than an annual one, since it compounds faster. Lastly is the duration. How long you keep the money in the investment will determine how much you will earn. The first compound interest investment is your high yield savings account. This type of account pays much higher interest than your regular standard savings account, while you also have access to your funds anytime. Typically, they require a higher deposit requirement to open the account, but before the pandemic downtime, the highest I've seen on a high yield savings account was around 3% per year. But the interest rates are variable, meaning they can increase or decrease at any time. So during the recent years, it was as low as 0.5% per year. And another thing about HYSA is that they may have a limit on how many times you can withdraw in a certain period. As of this video, some of the top HYSA from UFB Direct and My Savings Direct pays above 4% per year. I will leave the links in the description to both of them. Similar to HYSA is the Certificate of Deposits, also known as CDs, and they are very similar to HYSA except for one caveat. You must keep your funds in the CD for the whole term, and if you withdraw the funds prematurely, you'll pay a penalty, which is typically 3 months of interest. The benefits of investing in a CD is that the rates on them do not change like HYSA does, so you can lock in the specified rate while locking up your funds. But if you're scared of locking up your funds, then you can use a method called CD ladder method. Instead of putting all your capital in one CD, you can split up among several of them with different maturity dates. For example, you can have CDs maturing every 6 months so that you can always have the funds ready in 6 months while leaving some of the capital. I'll leave a link to a CD that offers up to 4.45% in the description. Now, if you're interested in growing your balance while investing in the stock market at the easiest way possible, then you need to consider mutual funds. Mutual funds are a basket of securities like Apple, Tesla, Microsoft, and Meta. They are actively managed by fund managers who will decide what companies are included and when to buy and sell them. The basket may include stocks, bonds, and other assets, and in result, the price of the fund will fluctuate throughout the day. Since you're investing in the entire fund, you don't actually own any of the shares in the fund, but instead own a share of the total fund. This is a great way to diversify your portfolio while keeping it for the longer term of at least 3 to 5 years. Although the mutual fund is at the mercy of the fund manager, if you do your due diligence and find a reputable fund manager, then it can be a great way to have a hands-off investment that compounds its earnings. But personally, my favorite investment is through ETFs or exchange traded funds, which is a basket of securities that track a specific index. For example, the ETF symbol SPY tracks the top 500 companies in the US. So similar to mutual funds, you don't actually own the shares of the individual companies, but own a piece of the fund. ETF are also passively managed, so there isn't a fund manager that is actively buying and selling funds. Hence, the cost of owning owning an ETF is very low compared to a mutual funds, and I also have an entire video dedicated to investing in an ETF, which you can check out after this video. Ultimately, ETFs are very easy to invest while keeping everything automated and diversified. You can also trade them anytime during the day, which means that it's also easier to manage your portfolio should your financial goals or risk tolerance change. Real quick, investing in an ETF can easily be done by any investing broker. If you're currently not using one of them, then you have a chance to get free money, some free stocks for signing up using my link in the description. Make sure to check out the links down below in my description to open up a free Webull account. Link your bank and deposit just $100 to get 12 free stocks valued up to $30,600. If you're looking for the most safest compounding investment, then take a look at Treasury Securities. Treasury Securities is a way for people to lend money to the government for a specified period of time in return for a compensation. Although they pay a lower interest rate than a high yield savings account, Treasury Securities are full faith and credit backing of the government, meaning an investor is guaranteed of their interest and the principal money that are due as long as you hold till maturity. There are three types of Treasury Securities, and the first is the T-bills, which are short-term securities that mature in 1 year or less. They do not pay interest but are sold at a discount to their face value and maturity face value. For example, if you buy a 1-year $1,000 T-bill for $900, you will still receive $1,000 back when the T-bill matures in 1 year. Next, we have the Treasury notes or the T-notes, which are the securities that mature between 2 to 10 years. However, they do pay an interest every 6 months and are sold at face value. Last one is the T-bonds, which mature in more than 10 years and will pay an interest every 6 months and are sold at a face value. To invest in these securities, you can purchase them directly through the US Treasury website or through a broker. I've mentioned about mutual funds and ETFs earlier, but one of the best compounding interests is through stock dividends. Some stocks will pay dividends, a portion of the company's profits, to the investors. You can choose to reinvest the dividends, compounding your earnings even further, but you can also choose to withdraw them whenever you want. Let's take a look at Coca-Cola, which has an annual dividend yield of 2.78%. The current stock price is $63.40. This means that for every share of the Coca-Cola that you own, you will get a $1.76 per year, but they pay dividends every quarter. Meaning if you were to reinvest your dividends every quarter, then you'll be earning another dividends on your initial investment and the dividends that you reinvested. So if you have little money to invest, I highly recommend checking out the brokers in the description, which allows you to invest in fractional shares in the amount that you prefer. Have you ever gotten a loan before? But did you know that the loans are actually provided by investors? With peer-to-peer investing, you can invest and lend out your money for an extremely high interest rate. But of course, with the high interest rate comes a high risk. Because as you know, there is a risk of borrowers defaulting on their loans, which means that you lose the amount of money that they default on. If we take a look at one of the top popular lending platform, Prosper, we can see that the top tier loans have a return of 3.6 to 7.9% with the lowest risk possible. As you get to the higher riskier loans like DHR weighted mix, you will get 3.5 to an upward of 11.5% in return. The good thing is that the lending platform will check the borrower's credit scores, income and bank statements and other assessments to ensure high probability of your return. Also, when the borrower misses a payment, you get the share of the late fees. However, if the borrower gets sent to the collection, there is a recovery rate of loan ranging from 7 to 12%. One of my favorite ways of compound interest is investing in real estate. There are 3 ways to invest. First is to buy a physical real estate property, which is just buying and holding the physical property to compound your earnings in terms of appreciation on the value of the property and the monthly rent that you can take advantage of. Another simpler way of investing in real estate is through REITs, also known as Real Estate Investment Trust. A REIT is a real estate company that buys, runs, and sells commercial properties. As an investor, we buy a share of their company and get a piece of the profits. But my favorite method is through a crowdfunded real estate, which is when you pool your funds with other real estate investors to buy and manage properties. But as with the physical real estate, all the methods of real estate investing should be taken as a long-term approach to growing your money, since it's not the most liquid asset asset that you can just sell anytime. A cheap way to start investing is through the app called Fundrise. You can expect returns higher than REITs and stocks when you take a look at the historical client returns. I'll leave a link in the description for a $25 bonus shares when you sign up. Alright folks, if you haven't received your 12 free stocks from Weibo yet, all it takes is to use the link in the description and deposit $100, which you can withdraw anytime. Like mentioned, I will leave all the links in the description for the investment signups mentioned in the video. With any type of investment, do your due diligence before you commit to any investment, and my best advice is to diversify your portfolio in several of the options to minimize your risk. As always, thanks for watching. Peace.